Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we're going to take a dispassionate look at a controversy that has hogged the headlines all of last week, the spat between government and the Reserve Bank of India. I emphasize the word dispassionate because the spat conducted through media channels has all along been anything but dispassionate. Now that the hatchet has been buried, at least for now, and we hope for the foreseeable future, we're going to try and set aside the central issue of central bank independence and look instead at the specific issues that are the bone of contention and remain unresolved: liquidity, PCA or prompt corrective action, transfer of RBI reserves and the payment system regulator. In the run-up to the next board meeting of the Reserve Bank of India on 19th of November, we're going to try and draw up a blueprint of how the government and the RBI could possibly work together in a spirit of give and take, because ultimately both work in the national interest. Of that there is no doubt whatsoever. And to help me do that, I have with me a panel of level-headed experts who have a thorough understanding of these rather technical issues. So let me welcome to the show T.T. Ram Mohan, Economics Professor at IIM Ahmedabad, Hemendra Hazari, Independent Banking Analyst, and B.K. Bhoi, former Principal Advisor in the Monetary Policy Department, Reserve Bank of India. As an economist turned banker turned central banker and now journalist, with your permission, I will also join in from time to time. So let me start with the first, liquidity. What is the best measure of the adequacy or inadequacy of liquidity? And if it is inadequate, what can we do about it? Let me start with you, Dr. Bhoi.
See, liquidity condition as of now is certainly tight, and this has happened mainly because of four things. That foreign exchange operation of the Reserve Bank of India, foreign exchange assets has come down by around $30 billion since March 2018. So $30 billion, if it is translated into rupee, will be around 2 lakh crores, of which Reserve Bank has injected 20,000 crores in September and through OMO, 36,000 in October. And November they have a plan to inject 40,000 crores, of which only 10,000 crores has been injected on November 1. So total comes to about 66,000 crores they have already injected. They have a plan to inject another 30,000 crores. It comes to about roughly 1 lakh crores. Then the balance amount will be reflected on a day-to-day liquidity management. As of now, the net injection to the system is around 75,000 crores. So these 75,000 crores will come down once these three OMOs which are lined up in November, they are affected over a period of 1 month. Now liquidity management is a continuous process. So this time the liquidity has become tight not only because of forex operation, but also recent pickup in credit and also festival demand. And some people also view that there might be some demand for currency because of the ensuing election. All these four things, they came together, therefore liquidity shortage is felt. But liquidity shortage can be resolved over a period of time as per the OMO that has been lined up for November.
TTR, Dr. Bhoi spoke about the fact that the RBI has been doing a lot of OMOs, but OMOs are essentially the shorter end of the market. And if, as he admitted, liquidity is tight, what should the RBI do about it? Should it do something, and what should it do, TTR?
Yes, first of all, I think it's very difficult to get a handle on the liquidity position, because depending on the measure that you're using, your response will vary. So I think one of the straightforward measures is whether there's net borrowing from RBI or net lending to RBI. The other measure could be the call money rate, which also gives you an indication of the demand for funds and the supply of funds, the overnight market. You could also look at deposit rates of banks, whether they are going up, and therefore because they are constrained for funds. So depending on the measure that you use, you will have to decide how exactly you need to respond. Now, as far as the present situation is concerned, going by the information that has been reported in the media and what we are hearing from market players, there certainly seems to be an acute liquidity problem, because I understand that commercial paper maturing in the next week or so is to the extent of 50,000 crore to 100,000 crores. And this amount, which is not being rolled over by the financial markets or by NBFCs, has to come from some other source. So that is the nub of the issue. If the NBFCs are not going to roll over these funds, and if they are not in a position to roll over, and financial markets are not in a position to roll over, then this liquidity need has to be met by banks, and therefore what are the facilitating measures that we need to create so that this kind of money can flow from banks to wherever it is required. So this is a very important issue, because the players who are most vitally affected are the SMEs, the small and medium enterprises, who are heavily reliant on the NBFCs for funds. And if the NBFCs are not going to provide these funds, because they are themselves constrained in terms of accessing the financial market, then the banks have to make good the shortage at the NBFCs by providing extra funds so that it flows on to the SMEs. Direct bank lending to SMEs is far from satisfactory. Not only SMEs, but also retail to a very large extent. There are various niches in the retail market that are catered to predominantly or exclusively by NBFCs. So this is the essence of the problem. Who is going to replenish the fund requirements of NBFCs, given that the financial markets have seized up? If the banks are not going to step up to the plate, then how do we deal with this issue?
Okay, Hemendra, what is your suggestion? Both TTR and Dr. Bhoi said that the situation is tight liquidity. Dr. Bhoi felt it's enough that the RBI is doing almost. TTR felt it's not enough perhaps. What is your suggestion? What could the RBI do if both agree it's tight? Clearly the Reserve Bank of India has to do something. What, Hemendra?
See, today the tightness in the liquidity is really in the commercial paper market, as well as which has really come about because of the NBFCs. Now the issue really is here that just like in ILFS, where people originally thought that it's a liquidity problem, it just may well turn out to be a credit risk problem of the NBFCs, because these particular NBFCs have been running up, just like ILFS, a huge asset liability mismatch, and there are also now major concerns on their asset quality. Now all this has surfaced because of the ILFS meltdown. So there is not really, I don't think that even if you provide liquidity from some corner to the NBFCs, which is really difficult because RBI can provide liquidity to banks and they in turn provide the liquidity to the NBFCs, and of course the mutual funds also provide. But today there is a problem that people are now questioning, just like they're questioning the solvency of ILFS. A lot of these NBFCs and housing finance solvency is also being questioned. So in such a case, that even if you provide more liquidity, it may not solve the problem, and therefore these NBFCs have to really recapitalize themselves through equity infusion, which at short-term notice is very difficult. So I fear that you're going to have this problem will persist, because the government will keep saying that it's a liquidity problem, while market participants will sense that it is really a credit risk problem, just like it is it's a solvency problem today with ILFS. So the issue really is that even if you provide liquidity, it may not actually reach the NBFCs, and two, even if it reaches them, they are going to have far greater problems today.
Okay, so we really are in a catch-22 position as far as liquidity is concerned. But let me now move on to the prompt corrective action. For the benefit of our viewers, can I ask you, TTR, to explain PCA very briefly and then go on to whether there is any scope at all to tweak these norms? You've written about how many of the norms that we have in India are higher than international norms. What is the logic? Is there a case for a relook, especially since most of our banks are majority government-owned, TTR?
Yes, prompt corrective action relates to the restrictions which the RBI imposes on a bank when it fails to meet certain measures of good health, and these measures are defined in relation to capital adequacy, the asset quality, that is the proportion of NPAs in relation to overall advances, and also the return on assets. These are the three measures which RBI uses, and if you fall below certain thresholds on each one of these, then the RBI imposes various kinds of restrictions on you depending upon the severity of the problem. So they have defined three different thresholds: risk threshold number 1, risk threshold number 2, risk threshold number 3, and depending upon the level of risk or the health of the bank, the restrictions vary. So if the risk threshold is only number 1, then they will place restrictions on dividend payout. If it's more severe, then they will say no branch expansion. If it's even more severe, there will be restrictions on compensation. So this is just illustrative. This is not an exhaustive list of the restrictions. But what happens essentially is that where the risk threshold is above a certain level, the bank is not able to continue its lending function. So they say first come back to good health, either by disposing of your assets or by better management of your balance sheet, or by cutting costs or whatever, and then we will allow you to lend. And when this happens to bank after bank after bank, as is only to be expected, it results in a credit crunch, which can create problems for even relatively healthy lenders. So there's a balance to be struck. I mean, on the one hand, you have to prevent the situation in particular banks from deteriorating so that they don't collapse. At the same time, you should not create a credit crunch that is so severe that even the healthy lenders are affected. So this is the nub of the issue. If there is not enough credit flow to the borrowers because of prompt corrective action, then the whole system can get into trouble. So this is where the pressure is building up to ease the PCA requirements, and one of the items which is targeted is the capital adequacy requirement, where in India we are 1 percentage point above the international norm. So internationally, when it was 8%, we were 9%. Today I think we are 10.75 compared to whatever is the international norm. It will be at least 1 percentage below that. And so what the government is saying is that why don't you lower the threshold to make it align with the international requirements instead of choosing to be ahead of the curve, because the higher the capital adequacy, the lesser is the credit flow to borrowers. So that's the point that you're making. And so this is a sort of debatable issue. I mean, one can understand the RBI wanting to be very conservative. It's good to be very conservative. At the same time, there is a case to be made for certain counter-cyclical actions when there is a severe credit crunch.
I would agree with you entirely, TTR. But Hemendra, would you agree with TTR too?
Now, while RBI can relax to a certain extent the PCA norms to allow these banks to lend, the central problem is that the Indian banking sector, including the government banks, are facing with huge losses, and therefore they need to be recapitalized to that extent. Now, the central problem with a lot of these issues is emanating from is that the government is unwilling to increase its fiscal deficit, because it has given certain targets to the financial markets and global credit rating agencies, and therefore they are finding it extremely difficult to meet those targets. So as a result, instead of recapitalizing the banks to the fullest extent, and which will lead to an expansion in the fiscal deficit, they are trying to force other entities to come in to recapitalize the banks, or ask the Reserve Bank of India to dilute the norms. Now, these arrangements, even if they do, they are going to be just temporary band-aid arrangements, which is not going to solve the problem. In any economy which goes into a slump and there are huge losses, the banking sector takes a hit, and the only way out is to recapitalize your banking sector and for the fiscal deficit to expand in that time period. But unfortunately, we have tied down our hands, because in this entire economic philosophy of ours, a fiscal consolidation is very good, any fiscal expansion is viewed extremely negatively. So as a result of that, you're getting all these problems because the government is unwilling to spend on anything.
So Dr. Boy, let me ask you, where do you kind of fit in? TTR would prefer some tweaking and some relaxation of PCA norms. Hemendra says recapitalization is the answer, and even if it does some damage to the fiscal deficit target of the government. Where do you stand, Dr. Boy, on this?
But see, my take is very simple. Reserve Bank had given the concession of lending, restructured debts were treated as standard asset. You know what has happened to the non-performing asset. So any relaxation at this stage will further deteriorate their position, and there may be more bailout program in the times to come. Till such time their health, the balance sheet health improves, they have to manage with investment rather than giving credit. So this is the standard prescription that is followed around the world. Till such time their balance sheet health is not improved, they have to continue with what is called non-risky investment. That is what is very much necessary. Till such time they are not on board so far as their capital is restored. So they will face this problem. There is one more thing, the banks which are under prompt corrective action, their advances is hardly 18.5% of the total credit portfolio of the scheduled commercial bank. So even if there is some restrictions on their lending, the demand for credit is met by the non-PCA banks. Now credit growth has now become double digit, 12 point some odd percentage. So credit, all the productive demands are being met by non-PCA banks.
Dr. Boy, I must disagree with you on this. 18% is a very sizable quantity, number one. Number two, I think it's important that this is a kind of a textbook kind of answer that let banks do only investment. Ultimately, the country needs credit to grow. But I'm afraid it's time for us to slip into a very short break at this juncture. Please do stay with me. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with three experts in the banking arena, and we're trying to draw up a constructive roadmap for the discussions between the government and the RBI, given the kind of, misunderstanding, debates, the controversy that has been created post Dr. Viral Acharya's speech in Bombay. Dr. Boy, let me now shift to the most tricky of all, the transfer of reserves. And here I'm going to start with you, Dr. Boy, because as someone who has been a career central banker, you have a much greater familiarity with RBI's balance sheet. Also, for the benefit of our viewers, I'll point out the need to make a distinction between the stock and the flow. The RBI's reserves, such as contingency reserves, for example, or the exchange fluctuation reserve, appear on the liability side of the bank's balance sheet and are a stock item in accounting parlance, to the extent that they are matched by corresponding assets on the asset side. Any transfer of reserves to government coffers would therefore entail a corresponding reduction in the asset side or a shrinking in the size of the RBI's balance sheet, and this will have a hugely adverse repercussion for the economy that, in my opinion, is best avoided. In contrast, there is a case for a greater transfer from the RBI's annual revenue, which consists essentially of seneraj, or the difference between the face value of the currency and its cost, and arises largely from its note issue function, its earnings on the holdings of domestic government securities and foreign securities. So what we need perhaps to have a clear set of rules and guidelines about how much of RBI's annual revenue, it should transfer to its reserves, and how much it should send to government. So is there some kind of ideal level? Can we have rules framed by some kind of expert committee? We had the Maligam committee and the Usha Thorat committee in the past, but is it time for a rethink, Dr. Boy?
So, the earlier I fully agree with your assessment. To start with, there was an agreement that Reserve Bank should have contingency reserve and asset management fund at least around 12% of its total asset, and Reserve Bank could achieve up to 10.1% in March 2013. That has come down to now 7%. Now, central bank is an important player in the market. They are operating in the domestic market, they are operating in the forex market. So, all these operations are subject to market risk. If they do not have contingency reserve, then they will not be in a position to operate in these two markets comfortably. Suppose Reserve Bank incurs loss, then there will be loss of credibility of the central bank, and the central banks, those who have lost credibility, they could not be able to manage liquidity or impart stability in the financial system. So, it is very much necessary in principle to build up reserve by the central bank at least as much as that commercial banks are maintaining, around 10 to 12%. So, against this 10 to 12% reserve, the contingency reserve and asset reserve is now hardly 7%. That is one thing. Second thing, this is a stock. See, if at all there is a need to support the economy can be supported through all other methods, like liquidity is required, liquidity can be generated. Not that we have to transfer this to the government account, because this has been built up over a period of time after transferring the balance amount of profit. Now, profit transfer is also inflationary. Now, profit transfer on top of the annual surplus will be more inflationary. So, in a inflation targeting regime, transfer of reserve to the government is not advisable.
Okay, spoken like a true Reserve banker. But TTR, how can one strike really a balance between a strong Reserve Bank of India balance sheet and a strong India balance sheet? Because that in a nutshell is a crux of the debate. I think Dr. Bhoi spoke about the need for our central bank to have a credible balance sheet. Which is more important, the credibility of the country's balance sheet as reflected in the fisc, or the credibility of the central bank balance sheet? TTR?
Well, I mean, both are important, but nobody would argue with the proposition that the RBI needs contingency reserves, as a player in the market. It needs those contingency reserves. The question is, what is the appropriate level? And this, I think, is certainly something that can be arrived at by a committee using appropriate measures. Now, I am given to understand, I mean, typically you arrive at contingency reserves by using the value at risk method. So, what is the loss that you are likely to incur under certain market conditions, and therefore how much reserves do you need to cope with that loss? I believe that the RBI computes the value at risk under extremely stressed conditions. So, there one can debate, what is the level of stress at which you must compute the contingency reserve. So, this I think the range, if the external environment is extremely adverse, you can have a certain level of reserves. If the condition is not that adverse, you may not need the same level of reserves. So, there is a range that can be determined, and I think this can be formulated in a transparent way by constituting a suitable committee for the purpose.
Hemendra, would you like to add to that? Is constituting an expert committee the right answer, Hemendra?
No, obviously you need some expert committee, and there have been committees in the past which have discussed this, but the central issue remains that the stock of the reserve, which is mainly the revaluation reserve, really cannot be transferred, because as you very rightly pointed out, it will lead to a severe contraction on the asset side, which will totally be disruptive to markets. So, the central then question is how much of your annual income, which normally flows to the government through dividend, can it be significantly increased from whatever have been the present norms? Now, my point is this, that even if you increase it, it is not going to be that significant for the central government, because it needs a much massive inflow of funds. And the central problem always remains that the government is doing all these things because that it has fiscal deficit constraints, and therefore it is raiding all these institutions, whether it is LIC or the Reserve Bank of India or some other large entity like the oil companies, just so that to keep the fiscal deficit. So, my issue is, when the government is in need of funds, let it expand the fiscal deficit, let it try to convince the capital markets and the global markets that it requires these additional funds. Now, the only problem is, if you increase the fiscal deficit, over what the market expects, it leads to a massive capital outflow from your economy. And therefore, if you plan for a massive fiscal deficit expansion, it should be correspondingly met through capital controls. Now, both these issues are totally anathema to the markets today. So, actually, you're going to be caught in this trap where nothing is going to happen, and the economy will just continue to stagnate for more years to come.
That's a very dire situation picture that you're painting, Hemendra. But now let me move to the last issue, this issue of the payment system regulator. TTR, would you like to go first on this? What is the case? Should there be a separate payments regulator, systems regulator, or should it be within the Reserve Bank of India?
Well, I think payments and currency, they are an integral part of the RBI central bank's functioning, and therefore, prima facie, it does appear that it makes sense to keep the RBI as a payments regulator. But there are certain compromises that can be worked out. I mean, you can have an RBI person deputed to an agency which is doing these payments and working in coordination with RBI. If there's a sort of a perception elsewhere that needs to be sort of physically separated out of RBI, that requirement can be met through various artifices. But I think in principle, it makes sense to keep the regulatory function within RBI.
I would agree with you on that, TTR. Hemendra, do you have a different view, or would you also agree with TTR and me?
No, I would agree with TTR here, because this is a core function of the Reserve Bank of India, and therefore it should not be taken away. It has to remain with the Reserve Bank of India.
Oh, absolutely. And I'm sure, Dr. Boy, you would also like to agree with that. But what is your take? And let me give you the last word.
I fully agree. I fully agree, because government wanted to take debt management for last 3 decades. They could not be able to take it away. Reserve Bank in principle probably may not have any objection, because they are doing in a fiduciary capacity. In case of payment and settlement system, this is an integral part of the implementation of monetary policy. Monetary policy cannot be implemented without the payment and settlement system. Formulating policy is as much important as implementing the policy. So, implementation of policy is done through the payment and settlement system. So, payment and settlement system is inseparable from the central banking function, core central banking function. So, this is the weakest demand that is coming from the other side, that it should be separated from the Reserve Bank supervision.
Oh, absolutely. I think this is one issue on which all our experts and I also are in complete agreement. But clearly what it shows is that we've given some kind of an inkling to the RBI board, I hope, of the way forward, where there is give and where there is take, where there is scope for that. And like I think in the famous ad of Johnny Walker, the answer really is just keep talking. That's the most important thing of all. So thank you very much, Hemendra, TTR and Dr. Boy, for joining me in this session and trying to give a very constructive spin to the entire controversy. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.